Welcome everyone, and thank you for joining our Upside Avenue educational webinar series. This series is developed with your input. We surveyed our investors and followers to find out what financial and investment topics everyone is interested in learning about. And then we look for subject matter experts all over the country who can speak on these topics in hopes of providing you with knowledge and confidence to discover your upside. So watch your email for information about next month's webinar, and we'll also share it on our social media channels. We're also going to be polling you for your input on what our programming should be for next year. So please watch out for emails asking you to take our survey and let us know what investment and financial topics you're interested in learning more about next year. Today's topic is evaluating risk tolerance. We have a dynamic speaker today who has contributed to numerous articles and workshops about investing and how clients can improve their financial situation. He's been quoted in the San Diego Tribune, Orange County Metro, and Investment News magazine. His passion has been to exhaustively study how people grow and retain their wealth over a lifetime. And growing up in an Air Force family has taught him how to build wealth with limited income resources and the value of saving and reinvesting while building multiple income streams. When he's not helping his clients, he's taking part in triathlons and marathons and spending time with his wife and son. So without further ado, please help me welcome Bruce Doole, President and founder of Permanent Wealth. Thank you. Thank you for joining us today, Bruce.
Thank you, Jessica. Appreciate that. And really glad to be here for sure. And glad to be talking about this topic, which is so important to investors, to people who are considering investing for the first time. It's really crucial for them to know what your risk tolerance is and be able to define it specifically. And in this case, we're going to talk about defining it down to even a specific number and to compare that to what you're currently doing financially and what kind of investments you're making. So we'll go ahead and get started and talk about our agenda today and what we're going to cover. So we're going to talk about how to precisely match your personal risk tolerance to your portfolio. So again, like I just said, that's so important. It's really crucial when the markets are volatile, as they have been this year. This year they have been extremely volatile, so that when your portfolio, your investments are moving, they are moving to your expectations, either up or down, and not swinging wildly beyond your expectations, so that you might feel like you have to make unplanned adjustments, that's not what we ever want to do. We don't want to make extreme unplanned adjustments. We want to have a solid plan that's going to react the way we think it's going to. We want to assess if you're taking too much risk or too little risk. Obviously, we have to take some risk in order to be able to meet long-term financial goals. Being able to pay for your expenses on a monthly basis, that's what people have to do in retirement and do that without working. But we also have to think about how are we going to exceed inflation with our investments, because that's the inevitable march of time, is that costs are going to go up, just like taxes. And we have to prepare for inflation and be able to exceed that with our investments and be able to be tax efficient as well, because taxes go up, they go down, but we're almost always going to have to pay taxes in some form or another. And finally, how to track this volatility in your portfolio to see if it's actually matching what you had set up when you do your risk profile, which should be done every year. But you want to be able to make sure that that portfolio is tracking the risk that you can take right now, today. Obviously, that can change over time, and you should be making redoing that every year to see how those changes affect you, how your changes in life are going to affect your portfolio, and how emotionally that you're dealing with it. So let's jump into this. Okay, so here's a target, all right, and we want to ultimately be able to hit the center of that target with our risk. Most risk questionnaires out there, and most people have taken some form of risk questionnaire, but they just really don't hit the mark. They're based on, a handful of questions about your lifestyle or what you like, what you don't like. They're not really based on quantitative questions where one answer relies on what you just answered, and keep narrowing it down until you actually get a precise risk tolerance. So we want to be able to hit that center of the target. We don't want to just shoot blindly and keep missing it. And a lot of people keep missing it, and they don't even know that they're missing it. So you want to know, what are you shooting at, be able to hit your target, and make sure that you're getting a number for your risk tolerance that you can rely on, and that you can precisely match your portfolio to, so that you're comfortable when things are really volatile in the markets. Okay, so let's look at the next one. So most people see themselves, or an advisor might tell them, hey, you're aggressive, you're moderate, you're conservative, giving some sort of stereotype for what type of investor you are. And most of the time, this doesn't really work that well. We don't want to go with this old way of how do we classify ourselves into one word. And maybe you might look at yourself as somewhere in between, moderately aggressive, or that kind of thing. And it's different for every person, and it depends on, you might depend on your age, all these sort of things that aren't really that quantifiable. And then you got to kind of put all these numbers together into a pot, stir them up, and hope that you get that your risk profile somehow magically matches with your portfolio. We don't want to do that. We want each person should be specifically looking at their own risk tolerance with a very precise number. And when we look at clients, that we choose that between not just 1 in 5 or 1 in 10, like a lot of risk profile. We look between 1 and 100 to make sure that you've got a very precise number that you can match your portfolio to, and that you feel comfortable that it's going to react the way you think it should. Okay. All right, so here are the numbers. So instead of these aggressive, moderate, conservative typecasts, we give a precise number: 22, 82, 49, as you see here. So that you can feel confident that you have a precise number that you can match what you're doing in your portfolio. And your current portfolio might be completely different than what your risk number is. So you've got to make adjustments to make sure that those two numbers align, what your portfolio number is versus what your risk number is. Okay. All right. So most investors just don't understand why all this really is so important. And it really comes into play when markets get volatile, as I've said a couple times. Now, obviously, volatility means up and down. Most people are okay if the markets are moving up fast. It's the moving down fast that's the problem. And that's what we have to prepare for. That's what risk tolerance is all about. How do you prepare your portfolio for moving down fast in a short time frame? And in our case, we look at a 6-month time frame is a good measure to see what you're willing to tolerate as far as your portfolio going down. And obviously, you should be able to determine, hey, what kind of upside would I be looking at if I'm willing to accept a certain downside in that kind of time frame. Okay, so we want these to match. All right, so how do retirement contributions retirement account contributions and inheritance affect risk exactly? Okay, because these retirement account contributions typically are going to come out of your payroll into a 401k or 403b, something like that. And you do know how often they're coming out. They're coming out every couple weeks, most likely for most people every month. And your employer is probably matching it at some point, either immediately or maybe at the end of the year, matching some sort of percentage of your contributions. So you know what's going in. The question is, how is it being invested? And how are you able to see and track what's going on? It's difficult for investors to do that. Not to mention, inheritance happens when you really don't expect it. It would be great if you could say, hey, I'm getting this amount of money at this point, but that's not how that works. And the way it comes in can be vastly different. It could come in as an equity investment. It could come in as a cash or money market. It could come in, as bonds or even real estate that you might have to take control of. So it comes in many different ways and affects risk differently. So you've got to be able to take these things into account. That's why it's so important to know your risk number on your own portfolio so that you can weave in these contributions and the occasion, the inheritance when that happens appropriately. Okay, so let's look at the next, our next slide. So it all boils down to, what is your investment strategy? Okay, how does your risk impact your goals over the long term? Okay, as we talked earlier, you have to take some risk in order to reach these financial independence and retirement goals. For most people, it's just not going to work to put your money in the bank and hope that you'll reach your goals. You're going to have some growth, and you're going to have to overcome this inflation number, which can vary. It's been very low recently, but based on, a lot of it depends on what's going on in the economy, government spending, how government sets interest rates, those kind of things. And you've got to be able to take that into account. And when inflation is rising, you've got to make sure that your portfolio is able to exceed that over the near term and the long term. Okay. All right. So we've come to the end of our presentation, and I'm gonna take a few questions here. Let me take a look. One of the questions I see is, all right, I've got a portfolio, and I see it's got a mix of stocks, bonds, some cash. How do I assess what my risk is in this portfolio? And that's a really great question, and it's tough for people to do that. That's why when we work with clients, we are able to look at those assets inside the portfolio and really match that up to a precise number. We can look at literally any stock or mutual fund or bond or exchange traded fund. We can look at real estate, all sorts of things, and we can get it down to a risk number. And we can say this asset is a 42 or this asset is a 65. And then we blend all that together and we look at the different percentage, how much you have in different investments, and you get a number. And then you look at, hey, what did my risk profile look like? What is that number, and how close is it to my portfolio number? And for the most part, it's wildly different. And that's another question that I'm seeing here. How often do these numbers differ? And I would say, and by differ, I mean more than, say, 5 or 10 points difference. Because if you're within a couple of points, you're really close. And that's what we want. But how often are they different? I would say 85, 90% of the time when I look at a portfolio for the first time, it is 5, 10, 20 points off of what the risk profile is. And so what does that say? That says that you've been taking way more risk and volatility than you really want to deal with, or you're taking way too little risk and you're going to have a really difficult time trying to reach your financial goals. Ultimately, being able to retire comfortably and pay your, the expenses that you've um, been paying for with the lifestyle that you're currently living. So that's our goal. How do we help you be able to maintain your current lifestyle and not have to work? Ultimately, everybody's going to have to do it. It's called retirement. It's most likely going to happen for most people in their 60s. For most of our clients, I am advocating that they determine what their retirement date is and how old they are, not letting your job or the government tell you what it is. So we try to help clients set a very aggressive retirement goal, but knowing these risk numbers is crucial in being able to do that. So both of those were very good questions.
Bruce, I have a question.
Yes, Jessica.
From a general perspective, if someone has more, they know they're pretty low at risk tolerance versus someone with a higher risk tolerance, generally, how should a portfolio makeup look like, from a type of assets, if they're more on the low side versus more on the high risk side?
Sure. So we're looking at a portfolio. If it's fairly balanced, it's going to be right around that 45 to 50 sort of mark. That's an even mix between, say, stocks and bonds, roughly a 50-50 mix. And as you climb higher into the 50s and 60s, that percentage of growth investments like stocks, for example, or stock mutual funds or exchange traded funds is going to keep increasing. And we have clients that are in the 70s and 80s on their risk tolerance, so they're going to have a very high percentage of stocks in their portfolio. So that's one aspect of this. I have other clients that are really low, say in the 20s or 30s with their risk tolerance, and so they've got to have a much higher percentage of bonds and income producing investments, even more cash. So they feel comfortable how their portfolio is going to move. But we got to make sure that they're getting the income that they need. They're probably going to be mostly retired in that kind of circumstance. So that's how it looks, mixing that up like that and looking at those kind of percentages.
Sounds good. So it sounds like on the latter example that you shared, that's where your alternative investments, real estate, the long-term investments kind of come into play in that portfolio scenario then?
Oh, when you're young, those alternative investments like real estate are crucial because they are really, some of them are really good for generating cash flow, current cash flow, which helps you be able to pay your expenses and allows you to build up a cash flow portfolio, which is what we look for with younger people, building up a cash flow portfolio with growth investments so that you can pay your current expenses as soon as possible with your portfolio. That allows you to be financially independent and decide whether you want to keep working at your job or not keep working. And from my experience, when people are financially independent, once we go have that conversation, they will usually quit their job in somewhere less than a year, which was surprising to me. I would not have expected that. I would have thought that would be more like a 3 to 5 year sort of time frame. But the vast majority quit their job in less than a year. And part of that is because they've been looking at, as they've been getting closer and closer to financial independence, looking at other things they can do besides their job. And because they've been so good at it, at saving and investing properly, they realize that they have options and they take advantage of those options.
Wonderful. Thank you. So thank you, Bruce, for sharing your knowledge and providing some really helpful tips about understanding our risk tolerance levels.
Thank you, Jessica. It was a pleasure to be here.
Thank you. And thank you to our listeners for joining us. If you'd like to contact Bruce, we've shared his contact information on the screen here. And let us know how helpful this content is by taking the short survey at the end of today's session. And also let us know what other financial and investment topics you'd like us to cover. We will find subject matter experts like Bruce who can speak on these topics because at Upside Avenue, we're committed to helping you live your upside. We are working on next year's programming now, so please watch your email and take the survey that asks what investment and financial topics you would like to explore next year. Watch your email for next month's webinar on investing for retirement, and follow us on Facebook, Twitter, LinkedIn, and Instagram for the latest industry news and insights. We also have a library of past webinars that you can access from upsideavenue.com/learn. Discover your upside with Upside Avenue. Through our non-traded REIT, you can enjoy the benefits of real estate investing for as little as $2,000. You can visit our website, upsideavenue.com, send us an email, or call us with any questions. Thank you for joining us. Stay safe and see you next time.